Markets are broken down into sectors. Sectors are broken down into industry groups, and industry groups are broken into individual stocks. Today, let's take a look at the individual sector performance and really break down what are our hot sectors and how are they performing on today's Market Brief. Happy Tuesday, everybody. Hope you guys are having a great day. We are going to take a look today at some of our top performing sectors. When we look at our sectors, we're looking at how's the market broken up and how are different stocks related to one another. Walmart is in a different sector than HP, right? It's going to be Apple that's in a different sector than ExxonMobil. And so knowing how each sector is performing is a really good way to see A, where's the market from a sector rotation basis, but B, what stocks might be the ones that are going to come into favor. And so what we're going to do is we're going to use ETFs, exchange-traded funds, as a proxy to look at our sector performance. So let's go ahead and dive into the charts. And what you can see here, there's a lot of stuff going on here, and I know it looks pretty busy, but this is a grid of our sector spider ETFs. Now, a sector spider ETF, if you go to sectorspider.com, you will get the list, hashtag not an ad, you will get the list of the different sector spider ETFs. There's 11 sectors of the S&P 500. XLRE, which is real estate, XLE, which is energy, XLU, which are utilities, XLK, which is our technology sector, XLB, basic materials, XLP, consumer staples, XLY, consumer discretionary, XLI is industrials, XLC is communication services, XLV is healthcare, XLF is financials. Now, I can click on one, and let's just use XLI as an example. If I want to look at one particular ETF, say XLI, I can see the current weight of XLI and what, it makes up about 8.25% of the total S&P. I can see a price chart about it, but what I really like to look at are what are the holdings, right? Well, I can see what are the largest holdings, and Union Pacific is the largest holding in XLI. It's followed by GE, followed by Honeywell, followed by Caterpillar. I can get a list of all of them as a CSV or an XLS file if I want to start to track and maybe chart individual stocks in that sector. But the sector performance itself, I can use a chart like this to show me where they all stand. So starting first at the SPY, which is our S&P 500, right? And what you'll notice here is that my candlesticks line up very well with this purple line. That's because that purple line is a comparison chart of the SPX. So we're looking at the spiders compared to the SPX. Well, obviously, those should have a pretty strong correlation. But let's go look at our first sector, which is XLE, which is energy. So right away, we can see that energy is underperforming the S&P 500 in general. I can also see that energy is in a bit of a downtrend. So if I'm looking for bullish stocks, XLE would not be the list that I would be looking at. I would avoid stocks in the XLE space. Matter of fact, XLE, if it breaks below here, looks like it's going to continue to run down a bit further. And this is, a drop in the price of the energy stocks. Over the course of the last year, the S&P is up 15.36%, while XLE is down 0.46%, which means it's a strong underperformer. XLY, which is our consumer discretionary stocks, are up about 26% over the last 1 year. So higher than the S&P from a performance standpoint, but also note the shape of the XLY relative to the S&P. So if I just look at the XLY and the S&P over the last 90 days, we'll see that the consumer discretionary is actually underperforming the S&P, right? But over the last year, it's outperforming, right? Over the last 1 year, it's outperforming. Well, why is that? Well, because when times are good, consumer discretionary gets really good. And when times are bad, consumer discretionary can get pretty bad. And so what we're seeing here in consumer discretionary is that the sector is starting to show some strength. And my assumption would be is that if the S&P continues to be bullish, consumer discretionary would rise faster than the S&P in general. So looking at consumer discretionary, if I'm looking for, some sort of an alert that says when consumer discretionary would be um, worth looking at, I would say that let me put a price line on here. Somewhere above here would be your probably most ideal entry. And that would be, let's show our price of about 163.94. So up above 164 is where consumer discretionary starts to get really attractive and maybe a stock worth paying attention to. Consumer staples, look at this, XLP, which are consumer staples, down 6.85% over the last year. Definitely an underperforming sector relative to the market, because in bullish markets, people are, these stocks are really, really heavily dependent on dividends. And a lot of times when we have high yields from our 10-year note and from our 30-year, people aren't necessarily looking for dividend stocks. And so definitely has outperformed the market in general. Now, if I look over the last 3 months, I can see that it's still outperformed, even though the S&P is basically flat over the last 3 months. And so, all in all, I'm thinking from a bullish standpoint, consumer staples would not be an area that I would look for opportunities if I think the market's going to rally up. Now, how about technology? Technology would be a sector where we would look for that. Matter of fact, technology is just about back to its highs from earlier this year. Not quite there yet, but almost. And when we put in those new highs, the chances of it going higher get considerably bigger. Now, this is one of our top performing sectors, up 44% over the last year, and really has exploded over this last little rally up we've seen in the S&P. Technology has gone up significantly higher. So, what would I look for? I'd look for potentially to see what the market does. And if the market continues to rally up, then this, we believe, would also continue to rally higher. Utilities, way down. Matter of fact, down 15% relative to the market being up 15%. And this goes back to what we talked about with consumer staples. Utilities are oftentimes going to be considered a dividend play. And a lot of those dividend stocks have become out of favor in favor of just the bonds paying a risk-free rate of return, if you will. And so not a place I would look for anything on the bullish side. Healthcare as well, XLV, also underperforming the market in general, in a strong downtrend, not something I would use when looking for bullish opportunities. Financials also below. If we look at financials, underperforming, but financials are actually setting up for a bit of a breakout level right above here. Now, that level is about $34 a share. So financials are setting up with a nice high base pattern, a little bit of a bull flag pattern, if you will, for a breakout above 34 and a propensity to move higher. So yes, it's underperformed the market, but over the last few days, the setup for that price is pretty good. Now, we do have a little bit of an area of overhead supply that is something that may come into play over the next couple of days. And so just be aware of that area up above us. But ultimately, I think that financials could be a good bullish opportunity. Industrials are another one that over the last few days, as the S&P has gone sideways, industrials have shown some strong relative strength. Over the last year, they're certainly still underperforming, but has performed similarly to the market in the past 90 days, right? Slightly underperforming, but looking at the shape, if you will, it's very similar in the shape of the performance of those markets in general. Basic materials, definitely not one I would look at right now from a bullish sector standpoint. If I'm looking for bullish opportunities, another one in a strong downtrend. Communications is our strongest sector. Communications and technology being our two strongest sectors. And certainly this is where we're going to find our Facebooks, our Googles, things like that, are in the communication sector. A breakout above this line here, and you're at essentially all-time highs, right? And so you have big opportunity for moves higher. This is our top performing sector, and has been for quite a while. This is probably where you're going to want to look, is communications along with technology. Real estate has found a little bit of basing. It looks like it's setting in a bit of a bottoming pattern, and some news that we may see a little bit of a cut in interest rates are going to have an impact on real estate. I'd be interested to see the fact that we got a higher swing high right here. If this becomes a higher swing low, does this look like a bit of an inverted head and shoulders pattern to give us a bit of a base for real estate investing? So that's it. Those are all 11 sectors. And out of those 11 sectors, I think that the top two sectors worth paying attention to certainly are going to be communications and technology, which many of those stocks seem to run together. And then after that, it's going to be, you're looking at consumer discretionary and financials. So financials, consumer discretionary, communication services, technology. That's where we're going to look for bullish areas and bullish opportunities. So hopefully this was helpful to you. If you have any questions, as always, send us an email, support@tradersarmy.com. Until next week, everybody, I will talk to you soon. See ya.